The 2016 video entitled 5 Bubbles Putting Market on the Verge of a Crash, which you were about to see, was produced just prior to Mr. Trump's surprise election, which extended the timetable for an impending crash. Investors becoming extremely optimistic allowed the bubbles, which had been in place in 2016, to expand to extremely dangerous levels by early 2018. Take a look at this 15-year 2003 to 2018 chart, which compares the prices of stocks and long-term bonds. When the stock market peaked in 2008, the spread between stocks and bonds, as depicted by the gold vertical broken line, was at its widest since 2003. The result was the spread closing or the stock market crashing down to the price level the bonds were at, as depicted by the yellow circle. The same thing happened for these 3 peaks. Due to the spread being very wide in 2016, had Mr. Trump not been elected, stocks would have likely crashed to the level of the bond market. Instead, after Mr. Trump was elected, the spread between stocks and bonds widened to an extremely dangerous level in early 2018. Here is another of the 2016 bubbles which has been updated for 2018. It depicts that the dividend yield for the S&P 500 declined from 2.2% in 2016, the third lowest since 1870, to 1.7%, the second lowest, by early 2018.
This video is available to you from Dynasty Wealth Investing. This presentation is about 5 bubbles which have put the market on the verge of crash. Michael Markowski, with 40 years of experience, conducted the research that is contained in this video. He was named by Fortune magazine as one of its 50 greatest investors. Michael predicted the collapse of Lehman, Bear Stearns, and Merrill Lynch in his Equities magazine column 1 year before Lehman went bankrupt. Michael specializes in global markets anomalies, small public companies, and digital companies that have the potential for 100 times return on investment. Here are the highlights from Michael Markowski's September 2007 Equities column. He stated that a day of reckoning was coming for the 5 largest brokers, and that it would be sooner rather than later, and it would be ugly. Besides this video, Mr. Markowski has produced 4 additional crash-related videos that are highly recommended. Market bubble number 1. The stock and long-term bond markets both reached all-time highs during July 2016. On Friday, July 8, 2016, long-term U.S. Treasury bonds hit an all-time high, and the S&P 500 hit a 52-week high. Subsequently, the S&P 500 hit its all-time high the following day on Monday, July 11. This marked the first time in history that both bonds and stocks simultaneously traded at all-time highs. Market bubble number 2. The stock and long-term bond markets no longer have an inverse relationship. This chart depicts the price histories for the long-term bond and stock markets from 2006 to 2016. Historically, bonds have gone to new highs when stocks hit new lows, and vice versa. This is a good example of the inverse relationship that bonds and stocks had prior to just recently. After Lehman went bankrupt, the bonds appreciated by 28% to new highs, while the S&P 500 declined by 38% to new lows. Here is the vice versa of the example that was just shown. After the stocks bottomed, the bonds peaked. Then the bonds declined by 25% while stocks appreciated by 40%. Since 2014, which is when negative rates were first introduced, bonds and stocks have been trending up together. This new trend is extremely disturbing. Here is why. This is the typical market cycle portfolio mix recommended by Manulife Asset Management. The cycle begins on the bottom left. When there is a recession, the recommended holding of bonds in a portfolio is 80%. As the economy recovers and grows, the mix goes to 12% bonds and 80% stocks. This shift can only happen by the investor being able to sell bonds at a profit to purchase shares that are depressed due to the economic cycle. This bar chart underscores why bonds are the crucial safety net for stocks, which is now missing. For every year that the stock market has gone down since 1929, the bond market has offset the losses for investors by producing profits. Now that bonds are going up with stocks, the mechanism or safety net of investors selling bonds at tops to buy stocks at bottoms and vice versa is no longer in place. Thus, both the bond and stock markets are continuing to new highs and do not have safety nets below them. Market bubble number 3. The S&P 500 is now priced like a bond instead of a stock. This chart depicts the long-term bond prices versus the bonds' yields from 2006 to 2016. The relationship between the two is exactly inverse as it should be. When the bond's price hit an all-time high on July 8, its yield was at its all-time low of 2.2% on the same day. This is the same chart with the S&P 500's price history added on to it. Notice that on the left-hand side of the chart, the S&P 500 mimics the bond yield. It's only logical that when bond yields go down, that stocks should sell off since the underlying bonds are appreciating. Remember, throughout history, bond prices and stock prices always had an inverse relationship. Based on what happened on the right side of the chart, the S&P 500 is now behaving as bonds instead of stocks. In addition, for the first time ever, the yield on the long-term Treasury bonds fell to below the dividend yield of the S&P 500. The S&P 500 will soon report its sixth consecutive quarter of declining profits. Declining profits should be driving stocks down instead of up. Bucking this trend for a year and a half provides further confirmation that the S&P 500 is now trading on its dividend yield like bonds instead of on its earnings performance like stocks. Market bubble number 4. The divergence between the S&P 500 and the small stocks is the widest ever. Not only is the S&P 500 trading at a premium to the low-price stocks index, but the current divergence between the two indices is the widest ever recorded. This is indicating that the S&P 500 is extremely overvalued, while the low-price shares index is extremely undervalued. Market bubble number 5. The S&P 500 is at all-time new highs, while the other major indices in downtrend. The S&P 500 has been trading consistently to all-time new highs during the third quarter of 2016. Yet the world's two other major stock indices, Japan's Nikkei and Germany's DAX, reached their 20-year all-time new highs respectively more than a year ago and have since been in downward trends. The divergence between the S&P and these two cannot continue. Due to the 5 bubbles forming, the S&P 500 is dangerously poised for a crash that could be epic.
Sign up at Dynasty Wealth for our free newsletter, which includes crash updates, etc. We highly recommend the Crash and Crash 9010 Crash Protection Strategy video, which is available at dynastywealth.com. It provides details about the only fail-safe solution that one can utilize to protect their liquid assets from crashes, recessions, and depressions. Also, remember to sign up for Dynasty Wealth's free newsletter for crash updates and to be alerted when the updated 5 Bubbles video becomes available.